Welcome back to Retirement News Online. Well, you've heard it before. When the markets become erratic or seem poised for a prolonged downturn, the best thing you can do is nothing at all. But if you're on the cusp of retirement, or perhaps worse, newly retired, a turbulent stock market can make you feel particularly vulnerable. My guest is Sean Bennett with Catalina Wealth Management in Tucson, Arizona. Sean, it has been said that market losses or corrections are way worse for retirees. Why is that the case?
So you mentioned earlier that when the market downturns, sometimes it's better to do nothing at all. But for retirees, it's a little bit more difficult to do. Historically, when given enough time, the market has recovered, at least to the same point, if not higher than when it was. But retirees, they face a different situation where they have the market downturn, but in combination with that, they're also taking income. So if we have a market downturn of, say, 10%, and then they're taking a 4 or 5% withdrawal on top of that, then they have that extra hurdle of recovery where they don't only have to recover 10% in the market, but they have to recover 14+% in the market just to get back to where they were. So if they're trying to sustain income for the rest throughout all of their retirement off of something that's in the market, and then they have a market downturn like that, taking income at the same time ends up being very detrimental or very difficult for many retirees.
When it comes to timing, explain sequence of returns risk and why it's so important.
Absolutely. So sequence of returns risk is the positive or negative returns over a given time frame. So say over a 5-year time frame, if you have 3 positive years and 2 negative years, depending on the sequence of those returns. For example, if you have a positive, negative, positive, negative, positive return, that's going to return a different returns for a portfolio than somebody who maybe has 2 negative and followed by 3 positive years of return. Historically, when you're looking at the charts, if you're not making withdrawals or not adding to these portfolios, the sequence of returns doesn't affect the portfolio at all. But when we're talking about retirees or people who are adding to their portfolio, sequence of returns ends up being very, very important and very critical to these portfolios. When you look at it for a retiree, if somebody's starting their first year in retirement and they have a significant downturn in the market in the first couple of years, then they're having to sell off some of their shares in order to have sustainable income that they can live off of. When they're having to sell off shares in a down market, have less shares to recover in the later years, and it affects them more drastically over the long term of their portfolio. On the flip side, if they had those negative returns in the later years of their retirement, it's not going to affect them nearly as much. So especially for people in retirement, when they're taking income, the order and the sequence of those returns are very, very important.
Sean, with bond yields at historic lows, what is the alternative?
Typically, the person who's investing in bonds is seeking stable, fixed amount of income. So there are other assets and other types of investments that can still produce those stable, consistent returns. So some examples of that, you might look at different real estate or private lending or even annuities. So different annuities are structured different ways. So different income annuities, for example, can provide that stable fixed income in times like this where bonds are just really not providing the amount of income that people need in retirement.
Finally, Sean, is it a good idea to purchase an annuity in a bear market?
Well, like many other investments, that really just depends on the individual. I wouldn't say an annuity is the right thing or a good thing for every investor, but given the situation and what that investors' needs and objectives are, an annuity might actually be a very good thing for them in a bear market. So it does depend on their amount of risk, how much time they have to accomplish their goals. But if they have a goal of income in a bear market, they can have income-focused annuities that will provide a stable amount of income regardless of if the market is in a downturn or in a bear market cycle. So this is an opportunity for somebody to have a fixed amount of income and even an increasing amount of income in some deferred annuities. Even somebody who may be looking at some kind of conservative growth, having some kind of a fixed annuity has a good amount of downside protection built into the product. So that way, they're even in a bear market, if it's a negative or flat year, their contract isn't negatively affected like it would be leaving the money in the market. So again, depending on the person, annuity might actually be a good thing in a bear market.
That's Sean Bennett in Tucson, Arizona. Thanks for watching Retirement News Online.